Hi, everybody. Welcome to the Futures Trading Explained webinar, 5 steps for stock traders to get you into futures traders. I'm going to wait a few minutes. We usually have people running in a minute or two late. But I think I'm going to put the agenda screen up while I wait a couple of minutes. And I'll tell you guys a quick story as well. I met Monroe Trout once. He was Trout Trading Company. And this is a true story. I was talking to him for a few minutes and he asked me what I traded. And at the time, I was only trading futures. And I said, futures. And these are his words, not mine, not plus 500s, not bar charts. He said, good, the real traders trade futures. I thought that was interesting. You guys can look him up. He was in the original Market Wizards. It's also important to note that not everyone in Market Wizards had that same attitude about futures, but he did. And I thought that was pretty interesting. So I'm just going to wait a few minutes and let a couple more people go in, and I'll put up the agenda slide. And there it is. This is what you guys will learn. If you read this while we're waiting, I don't have to read all of it, but I'll just go through a couple, point out some of the important ones. So just give me a few minutes here and we'll get started. All right, it looks like we have a good number of people in here. Again, my name is Bobby Iacchino, and before I go into the meat of this presentation, I want to thank Plus500 again for allowing me guys to talk to you. And also, I want to thank Barchart. Barchart.com is a great platform. They're partnering with Plus500 in this particular program. And I have a Barchart account. It's a great program. It's a great platform to look at. There's a free account you can sign up for. You can also upgrade, and you should at least get a free account because you get to see John Rowland, who is a chartered market technician. He's a CMT, and he has his Markets on Close show. So even with the free account, you get to see that show, and that in and of itself is worth it. So thank you to Plus500. Thank you to Barchart. You can see the agenda on the screen right now. Obviously, I already gave you the welcome. Here's what you're going to learn, steps 1 through 10, although these are 5 specific steps that I'm going to talk about. How futures are different from stocks, translating price movement into dollars. Margin is not buying power. What I think is probably the most important one. Quick answer in the chat here. How long is this webinar? About 30 to 45 minutes, just so you know. Expiry changes how you trade, plan risk before you trade, common stock trader pitfalls and futures, and then practice the transition safely. We're going to talk about Plus500's unlimited free demo with live prices. I'm actually going to show you something really important on their platform. So let's go ahead and get to the first slide, talking about what you'll learn. These are the things that just went over. So I'm going to get to the meat of this. I'm not going to reread this, but futures are different than stocks, but it's the same basic premise that you're trying to buy at a price and sell at a higher price. And the even easier part about futures is shorting. You don't have to borrow anything to short. You can just short right in the Plus500 platform. And that's something you really can only do with futures. There's no borrowing. All right. Why stock traders look at futures? So stock traders often come to futures because you get broader market exposures with one instrument. Now, it is true that if you wanted to trade the S&P, you could trade the SPY ETF. But one of the problems you get into with stocks versus futures is if you have an opinion in gold, you have to go to an ETF and you have to learn about the ETF and figure out which one is actually better for what you're trying to achieve. One of my biggest examples of this is always crude oil futures versus specifically USO. I did a speech, it was pre-pandemic. So I did a speech where I showed people times where USO, ExxonMobil, and Valero were all underperforming the crude oil futures by a drastic amount. And that happens on occasion because what you hear stock traders do is they say, I think crude oil is going to go up. So I'm going to figure out if I want to buy Diamondback Energy or Valero or Exxon. You don't have to do that with futures. When you're looking at gold, when you're looking at crude, when you're looking at silver or copper, the only thing that's 100% correlated to these particular commodities is that commodity. In other words, if you have an opinion on gold and you're going to buy a gold mining stock, you actually have to worry about the structure of the company, the CFO, the CEO, what their earnings are going to look like. Do they have control of their costs? But on a gold future, you're just trading gold. Gold is 100% correlated to gold. So that's one of the biggest advantages to me. The ability to trade indexes, rates, energies, metals. I talked about the energy and the metals right there. Obviously, interest rates, it is much more simple to trade interest rates futures than it is to trade TLT or TBT, because usually those are a mix of different expirations or different durations of bonds. It's not usually one bond. So if you have an opinion of the 10-year, which is one of the more broad interest rate products that will go across different areas of the economy, credit cards, mortgages, and such, you can go right to the 10-year. If you have an opinion on the 2-year note because you think it's going to be affected by what the Fed does, you go right to the 2-year. It is just much more micro focused on what you want. We used to have a program called Pure Exposure Growth Series, and one of our actual, this is me and my company, one of our actual focuses was that futures are pure exposure to the thing that you want to trade. And that's one of the advantages of it. You get nearly 24-hour trading. Futures are closed, but they're closed from Friday afternoon until Sunday evening. But otherwise, it's basically, and you have the electronic futures late into Friday. So you basically have what we call 23 and a half, 6.5 day a week trading in futures. No PDT rule. Okay, that's day trading rules that you have to abide by in stocks. Okay, it's called pattern day traders. Stocks, they don't allow you to day trade as often as you would like to day trade. There are limitations to how often you can get in and out of a trade on the same day. There's also tax advantages to futures, but I'm not going to comment on those because I'm not an accountant, I'm not a CPA. But you should ask your accountant, if you have one, about the advantages of futures, the tax structure for futures. And then built-in leverage. With futures, you don't have to open up a margin account and you don't pay interest on margin. I'll go into that a little bit more. You need to use the margin in futures responsibly, because I always say futures markets, the futures exchanges, they treat you like an adult. So in other words, you're responsible for the amount of risk you take. No one else is. So be very careful with futures margin. But it's really an advantage with the way futures handles margin over stocks. You don't have to apply for a margin account. Well, anyway, I'll go into that a little bit more. All right, so with stocks, you buy shares. With futures, you trade standardized contracts. Each contract has slightly different specifications, and you need to learn those, but they're not hard to learn. That's the thing. Everybody gets intimidated by the contract specs, but they're really not hard to learn at all. So all you got to do is look at that a little bit and say, okay, I need to figure out what crude oil specs are, what gold specs are. With stocks, you just buy shares in the company. But I'll be able to explain to you why this is an advantage in a little bit. Capital, shares times price. That's what you're doing with stocks. So in other words, if you buy 10 shares of a $100 company, it's going to cost you $1,000. Now, if you're on a Reg T margin, it'll cost you $500. But you know the exact math right there. With futures, all it is margin requirements. And this, I wonder if I should show you this right now. No, I'll save this. It's one of the advantages of the Plus500 platform, by the way, is right on the trade ticket, you see the amount of margin that is needed. And it really shows you the advantage of futures. But again, they're allowing you to automatically use margin on your day trades. So you can control a much larger swath of S&P futures, for example, or NASDAQ futures. You can put on a much larger position. Now, with that comes much more risk. Keep that in mind. But you don't have to just do shares times price. It is the tick value, and I'll show you that in a minute as well. In stocks, there is no expiration. Contracts expire in the futures. Now, I actually see that as an advantage. I really do, because I think I'm talking to quite a few day traders here. And if I'm talking to day traders, you're rarely, should I say rarely? It's not that often that you're going to be exposed to expiration. The futures markets are very efficient by changing contracts. So one day you're looking at trading the January contract, then a couple days later, you notice that the expiration month has changed because a front month has changed to a more further out contract. So for example, right now in the S&P, we're looking to trade into January contracts very soon, which means you don't have to worry about it unless you plan on holding it past January. There are ways to work with those expirations. You don't have to look at that in stocks. You do have to pay attention to that in futures. Stocks have company-specific risk, okay? I just talked about buying a gold miner and worrying about their accounting practices or their CEO and what maybe his or her behavior is and how that might affect a stock if there's a CEO scandal, or whether they're dealing with their costs effectively. Okay, there may be a miner that should go higher because gold is going higher and they're not. And that could be something internal in the company. It's company specific risk. You don't have that with futures. You're just buying the actual asset or shorting the actual asset. You don't have to worry about any of the other factors that maybe you can't see. None of us in this room are Goldman Sachs. We don't have inside information. All we have is price and the information that we know is factual. And a lot of the times, the information we know is factual, we don't know for sure. We're just expecting it to be factual. So you don't have to worry about that with futures. You do have to worry about that with stocks. You trade price movement in stocks, not ownership. You're not owning anything. You're looking for the price to move in your direction and covering it, or you're looking for the price to move against you and protecting yourself by covering it in a way that doesn't blow up your account. Here's how we're looking at translating price moves into dollars. Okay, with stocks, it's just $1 moves or 1 penny move or whatever you want to look at it. If I have a stock that I paid $100 for, just a similar example, I paid $100 for 10 shares of stock ABC. I put $1,000 into that. If it moves $1 lower, I've lost $10. Moves $2 lower, I've lost $20. That's it. Stock traders think in dollars. Again, if I have a $100 stock, I've bought 10 shares of that. If that stock moves $1 lower, I've lost $10. It's a very simple math equation. But in the other situation where you have futures, futures have tick values. Okay, so for example, we have an example up here on the screen where the tick value is $1.25, okay, of a particular futures contract. Actually, that is the micro S&P tick value. All right, so each tick move is $12.50 per contract that you own or are short. So what is a tick value? Well, in the micro S&P, for example, a tick value is 25 cents. So if I'm looking at the micro S&P being at 6,884.75 and it moves up to 6,885, that's a 0.25 move or 25 cents if you want to look at it that way. That's a $12.50 move. So if I have one contract, if I'm long one contract, let's put it into a winning context. If I'm long one contract, I made $12.50. If I'm long 10 contracts, I made $125. That's the tick value situation. And that's what everybody needs to understand, what everybody needs to know, is there's a difference in that, okay? It's not a penny move like you see in stocks. The tick value is the movement. And that's the math that allows you to control a much larger portion of the S&P 500 than you could in stocks. It takes a lot less money to control that. You just have to be careful on the risk side of things. And we'll talk about that a little bit too. So again, one contract, 10 ticks, you can see sort of the movement right here. If it moves 10 ticks on one contract, it's a P&L of $12.50, whether that's a loss or a gain, depending on what you're doing, okay? Let's go to the next slide. This is one of the more important slides that you have to understand. Margin is not buying power, okay? In stocks, you pay for the shares. And if you apply for a margin account in stocks, you may get it, right? It's called Reg T margin. It's 50% of the price of the stock or the price of the order you want to put in. Futures, you post margin as collateral, okay? In a weird way, the functionality of it is similar to getting a loan at a bank, except you don't pay interest in futures, okay? In stocks, you get a margin loan from your broker. You have to have at least $2,000 in your stock account to get that margin loan. They won't do it for you otherwise. And you don't want to use all the margin in your stock account if you even qualify for it. On the other hand, with futures, it's automatically applied to your trade, okay? Over here on the bottom right of the slide, you see basically an example of what it would look like, okay? Let's say somebody is going to, actually, I can show you this on the Plus500 platform. This may be the right time to do this. But basically, when you're looking at a trade, the margin is the amount that you have to show or that you have to put up. You don't have to put the full amount of the trade. I think I actually will do that right now. I'm going to go to here. All right. Just want to make sure you guys are now seeing my plus 500 screen. Is that correct? Help me out in here, guys, because I can't see what I'm presenting. All right, good. Looks like it's yes. All right. So on the plus 500 screen here, let's go to what I was talking about. Here you can see most popular instruments are loaded up when you hit the all popular. See this micro S&P right here? Let's say I click a buy button right there, okay? And you can see that the ticket comes up, right? If you look here, if I go ahead and try to buy one of these, all right, you can see on the bottom here, I need $70 to do that. That's the required margin. That's all I need. And as I up the ticket, you could see the margin account going higher. Okay, to buy 8 of these, I need $560. To buy 10 of these, I need $700. That's your margin. That's it. And you're controlling 10 micro S&Ps. So 10 miniature units of the full S&P 500. So this is what I mean by futures allow you to be much more aggressive, but you have to be responsible. Because by the same token, this is a much larger position than you would be able to afford with $700 in the SPY. So you have to be careful on the risk side of things too. This is not a one-off thing. Okay, let's go back to the PowerPoint. That's one of my favorite features, by the way, of Plus 500 is that particular feature where it shows you the margin right underneath the ticket. So if you have a particular trade in mind, okay, you're looking at bar chart, you're looking at your chart, you're saying, I think this is a really good long. You click one contract at $70. You want, well, I've got a bigger account than that. I can do 2 or 3 or 4. It allows you to see exactly what your margin is. Now, keep in mind, margins change, and I'll talk about that a little bit more in a second here. Let's go to expiry. Expiry changes how you trade. Stocks, you can just buy and hold forever. And by the way, for day traders, there's a huge negative about the ability to hold these stocks forever. And it's this. I know a lot of people that say, oh, I bought Tesla. I just want to see if it goes up in the next week or so. And then when Tesla goes down, if it does, they say, well, that's a long-term hold anyway. They change their day trades into long-term holds. Okay. And that's the way that they screw up their psychology because they had an idea for the position in the first place, and then it ended up being a long-term trade. They change it. That's a very dangerous habit to get into, extremely dangerous habit. Okay. So what you're looking at here is futures contracts have an expiration. So I just showed you the December, I think it was the December. Oh, no, I'm sorry. It was the March S&P Mini. The March S&P Mini expires somewhere around the second or third week of March. So from now till then, you don't have to worry about expiration. You don't really have to worry about it. So if you're an active trader, it's unlikely you're going to come across the problem of expiration. But if you do, most of your brokers, including Plus 500, will let you know somewhere in their platform that you have a position that is coming close to expiration. They will tell you to either roll it or exit it and buy the new month. So it is an extra step that you have to be careful about, okay? Expiration dates are clearly shown. You can see that on the bottom here. Instrument expiry date, 12/23 on the December contract. Current trading session, you got the time there. It's clearly shown in the Plus 500 platform. So you don't really have to worry about it too much. So let me get through this. Plan your risk before you trade. This is one of the biggest parts of the platform that you have to be very careful with the margin that futures give you. In futures, risk comes first. You're not going to be looking at something and saying, well, if my day trade doesn't work, I'll just hold it as a buy and hold. Can't do that with futures because of the extra margin. So common stock trader pitfalls, you oversize position, you let leverage dictate your decisions. I sort of described that a minute ago. Ignoring margin buffers, you need room between the money you have and the margin you're going to use, because if you hold something too long, it's too much risk, you'll get a margin call. forgetting about expiration, and trading futures like stock shares. Okay. Those are the biggest problems that stock traders take. So practice the transition safely. Join Plus 500, look at your bar chart charts, and then go ahead and place trades in demo. Plus 500 gives you unlimited demo, and you could trade and learn the way the futures behave. Okay. That is a very big deal. Stock trader takes away, they're different. Ticks replace share price. Margin requires discipline. Expiry matters, and risk must be defined upfront. I've maybe got a minute left for question because of that stupid Florida power outage. So if anybody's got anything for me right this second, I will do my best. Otherwise, you can find me on Twitter, Bob_Icino. Tell me you were in this webinar. You have to follow me and ask me the question, and I'll give it to you. I'll give you the answer as best I can. Also, you can reach out to Plus 500 and Bar Chart. But before this finishes, and again, I'm sorry for that interruption, guys. We'll have more of these to do. Okay, we'll have many more of these to do in the future. So watch Bar Chart, watch Plus 500 to see how many more webinars there are to do. And if I wasn't able to get to your question somewhere else, again, I apologize for that interruption. I wasn't happy that that happened. So I'm going to go ahead and yell at Florida Power and Light. Anyway, guys, thanks again for being here. Again, I apologize for that. I know it wasn't my fault, but I still feel bad because I feel like I could have done a better job on each slide. And I apologize to you guys for that. If there is anything you need, again, you could go to Plus 500. They will tell you how to get a hold of me. They have a lot of education on their site. Bar Chart, at least go watch John Rowland. Sign up for the free account at Bar Chart and watch John Rowland. He is really, really good. And thank you guys for being here. Thanks you guys for allowing me to talk to you. Thanks to Plus 500 and to Bar Chart. And I think I will see you guys sooner rather than later.